Welcome back now to our next conversation. Reports by PwC estimates that businesses may see a price rise of between 10 to 20% in the cost of their annual insurance bill. Firms said that this was the direct result of a rising consumer price index, which has significantly increased the cost of materials and labor and the settlement of claims. Let's discuss this now with Olushola Oguni, lead advisor at Finit Advisors Limited, joining us right here on the studio. Good morning.
Good morning. Thank you for having me, Ladi.
Great to have you. So, looking at this report now, how would you describe the relationship between rising prices, that's inflation, and the insurance industry?
Thank you very much. As we all know, inflation affects people differently. In a rising inflation period, it tends to affect the creditors more than the debtors. So if I'm owing you money, when I want to pay you and the value has dropped, you lose, I gain. So basically, so for insurance now, it affects the industry in different ways. It affects the insured, which is the people buying insurance. It affects the insurance company in different. So let's look at the insurance company. In a rising period of inflation, the claim payment, especially repairs, tend to go up. Take, for instance, auto insurance. You want to repair your car. You have a sum insured fixed at the beginning. But when you have repairs during the period, you tend to pay more. The only period that insurance could enjoy during rising inflation is when you have a total loss. 2 million, January, you insure your car, for instance, stolen in June. You pay 2 million, but inflation has eaten into it. Right. But if you don't have a total loss, let's say you have a repair of, let's say 300,000 naira. Without inflation, that could have been like 200. So insurance suffers for that. However, for the insured, they also suffer from life policies. Life policies, when you buy life policies, especially whole life, you keep making payment, and inflation, just as what is happening in the pension industry, inflation is eroding your purchasing power. So when you're doing life policy, you tend to suffer. But if you do a term assurance, for instance, like say 1 year or 2 years, you could be better off. So it affects people differently. There are protections you can use. You could negotiate for a kind of hedging or insurance clause that I want my claim to move with it. It could be expensive. That means you have to pay more premium. Right. So it affects people in different ways. So
that means we could actually expect rising premiums at this point?
Yes. In short, the insurance company are actually complaining. They are having more rising claim due to, if it's a property insurance, for instance, you tend to have cost of building materials going up. You suffer fire incident. When you want to buy those things back, you could have cost to close like maybe 50, 70 or 80%. Way above the average inflation rate, The average is just what we are seeing, about 70.7. But cost of building material within the last 6 months, you could have 70 or 60%. So that is a minus for the insurance company.
Quite interesting. Well, how would you describe consumer behavior right now in Nigeria towards insurance packages?
Thank you very much. This is quite interesting. Insurance is a very unique industry. For instance, for every 1 naira you pay for insurance, it goes through several stages. From that 1 naira premium, if it goes through a broker, an agent, it takes a commission. If that money goes to the insurance company, he caters for his own expenses. From that money, he wants to make profit. From that money, he wants to give regulators some fee. From that money, he wants to pay the insurance premium. So, it is unique. The behavior of consumer for insurance has not been too good. People don't actually want to do insurance. Due to several factors: culture, religion, and people do not see value in it. And it's not good enough. So the behavior has not been good. The awareness by the regulators, the industry association like NIA, NCRIB, they've been trying. However, that behavior has not moved the needle, and you can see the behavior in the insurance contribution to the GDP. Less than 1%. In South Africa is about 14.3%. In Kenya is about 3.4%, which is low. So insurance penetration is low. Insurance density is also low. An average Nigeria spend like $8 on insurance. In South Africa, it's about $800. In Kenya, it's about $43. So behavior is not there. So people need to see the value in buying insurance. If I may ask you, Ladi, what will make you to buy insurance?
As long as I can, make my claim and I get it.
Good. So I think the insurance company are listening. So long as you can get a claim.
On time.
On time. Good. So we had, let me just give you insight from of our survey. We asked people, do you understand insurance? Almost 100%, 95%, some states in Nigeria, they say yes. However, we asked them, in the last 3 months, and this survey was done in March this year, in the last 3 months, who has talked to you about insurance? They said, on average, about 70% said nobody has come to them to talk about insurance. So buyer behavior is also influenced by lack of maybe awareness. And some said, even if they talk to them, they don't know what to buy. Insurance is complicated. You need somebody to explain it to you. To be aware is no, you don't know about it, and that's sad. So people, the insurance behavior can be shaped from the policy angle. It should have a political prioritization that, hey, it is an essential part of the modern economy. It's bread and butter.
Right. And, we're seeing rising inflation at this time, and central bankers globally are trying to, tame inflation by raising rates. And there's also that risk of, a recession. And I'm wondering, what is the role of insurance in a slowing economy?
Interesting. Generally speaking, when an economy is slowing down, economic is not expanding, so that could also be seen on the insurance industry. So you see people tend to reduce their purchase of insurance. However, the insurance may actually pay more claims from policies like loss of employment income. Loss of income, you lose your income, you lose your employment and you don't have money, so you can actually get that. However, I will advise people in a slowing economy, that is the best time to protect your assets. Because suppose you are not making more money, you have some savings, you have some assets.
And your disposable income is being squeezed.
It's being squeezed, and you suffer a loss. You go to square one, which is always one. So what do you do? Protect yourself, even in a slowing economy. Protect your assets. So when the economy expands, you get by. As a matter of fact, in some countries, they actually take a loan to pay premium. It's like you have a house value at 10 million naira, for instance. A small house, an average house in Nigeria, 10 million naira. 20,000 naira, max, should insure the house for fire, for burglary. So you sleep well. In a slowing economy, people should try as much as possible to protect their assets.
But what about the insurance companies? Aren't they impacted?
Yeah, as I mentioned earlier, the premium rating drops.
Right.
And that tells on their underwriting performance. And if they have more claim, that could show on their claim ratios, the administrative ratio, or the general combined ratio. So everything, those ratios could increase. So it tells on them.
Recently, we saw NICOM revoked licenses, of some companies. How do you see this regulatory action?
Well, that regulatory action is a step in the right direction. Actually, last year, April 2021, NICOM also canceled the license of Unique, if you remember, Unique Insurance. So what NICOM has done is backed by law. Both NICOM Act 1997 and Insurance Act 2003. Section 8 talked about the cancellations of those, cancellation of license if they are not able to meet most time solvency ratio, they cannot continue to operate. So what they did is to kind of instill confidence in the industry, ensure that, okay, you don't continue to do business because they cannot obviously turn corner. And they've written them a March to come up with a plan of action, how you want to solve the deficit. There's a deficit in their financial performance. they cannot undo that. So the best bet for the NICOM is to, it's like you minimize their loss. What is minimization of loss? So those companies are in receivership now. The receivers take look at the scenario.
So what happens to the customers of those companies?
Yeah, the customers are fine because, one, the companies have stopped taking business. They can't take further business so that that will not complicate matters. The existing customer, especially those who have life policies, which surrenders value and all those that, so they will be well catered for. And interestingly, there is a section in Insurance Act, Section 78, if I'm not mistaken, is also in NICOM Act 1997, Security and Development Fund. That fund, according to Insurance Act, states that in the event of some companies being insolvent, unable to continue to trade, when the receivers have exhausted the available resources, look at the asset and liability to balance things up, the Security and Development Fund will actually be triggered to take care of the customers. And that fund can also be used for, people don't know this, uninsured vehicle or car that knocked down third party. Yeah, it's there. It's in the act.
Quite interesting.
Yes, so it's in the act. So the customers are fine. NICOM has done the best bet. Is a confidence boosting for the industry, minimize their loss, ensure that those who have the capacity in the industry can actually trade.
Okay, let's talking about risk management. At this point, what other options are there for consumers? Just putting insurance aside at this point.
Well, thank you very much. For a emerging market like Nigeria, insurance is still the best bet for retail.
Okay.
People should ensure. We have 5 compulsory insurances in Nigeria, and those compulsory insurances are from liability policies, meaning that if you do something and you are not able to, your legal liability to a third person, you don't have money to do that. Just buy like motor vehicle third party, like buildings under construction, more than 2 floors, like insurance of public building, like group life for employees, and like healthcare insurance, professional indemnity. Those are the key 5, apart from aviation. But other risk management measures we can talk of is like, say, self-insurance.
Self-insurance.
You can do self-insurance, but you must be careful. Before you do self-insurance, you must have an assessment of your risk profile. What are you exposed to? What are the frequencies? What is the likely impact in financial terms if those risks crystallize? So you look at those. The best bet to do self-insurance is look at those risks that have maybe high frequency but low impact. You don't want to self-insure an aircraft, for instance. The government will not even allow you.
Right.
So you can also do what we call alternative risk transfer. It's common in advanced market. It's coming to frontier and emerging market too. Insurance, there are some risks that the insurance industry will reject. Either they don't have the capacity for it, either the reinsurance, because insurance do reinsurance. The reinsurance say, we can't do this thing. Maybe they don't have data, the actuarial calculation has not been okay to generate that. So they can do alternative retransfer, whereby you take the risk to a place that you can protect yourself outside insurance. And you can as well do captive. Captive is also a form of self-insurance. NNPC, LNG, they have captive.
Quite interesting. Well, I guess the insurance companies have, a lot. The job is cut out for them at this point with all the, the global headwinds we're seeing, right now in the world with the war in Ukraine and rising prices and all of that.
That's right.
Anyway, thank you so much, Olushola Oguni, lead advisor at Finite Advisors Limited. It was great having your perspective on the show today.
Thank you very much, Ladi.
Thank you.
Thank you for having me.
All right.